Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Chris Bates from Wealthful. How you going, mate?
Good, Owen. How you doing, mate?
I'm very good, mate. Back for episode number 4 of our Property Investor mini-series. And today we're talking about the portfolio investor. And this is the person that has multiple properties, probably dresses up, goes to the party and says, I own this many properties. So we're going to talk about the ways this goes wrong, how you can, like from your experience servicing thousands of clients, how it may have gone right. We talked in episode 3 about the first time investor. And one of the things you emphasized there was invest in quality. And second of all, you probably only want to hold 1 to 2 really good properties for a very long time. It probably gives you peace of mind. It's a bit easier to manage. But there are a lot of people, Chris, that, sit back and they think, I got 20% equity or 40% equity in that house there. And, it took me a while to get to my second property. My third one's even quicker because I've got more equity is building up. And then I have a fourth one. And they just keep going and going and going. Can you just describe from a high level, maybe we can just talk about what's the appeal of being a portfolio investor in property?
Well, I think that there is sort of the belief that more is better, right? So buying more is going to get me a better result. We think a lot of those people, we know a lot of those actually come to us. We've had clients with 5, 6, 7, even double figure properties. And we actually, a lot of openly, we talk through their assets. Even this one last week, had 3. I just talked him through, this is, you bought a villa in the Central Coast, that's gone nowhere near the housing market in the Central Coast. And, you've got a villa in sort of Newcastle and how that's performing versus the housing market. You've got an apartment in Toowoomba or Bundaberg or something like that. And so I do think the appeal really is that 2 things. It's just the belief that the number of properties is what matters, not the quality. There's probably a bit of egos driving that as well, is that they get a bit of equity, usually through their house, to be honest. It's not their investments that have gone up. We feel like a lot of investors have unfortunately got a bit overconfidence bias at the moment. Because of low rates, it pushed up the affordability market, right? With, a huge increase in demand. So a lot of people looking to buy now and the same amount of properties on the market, right? If not smaller number of properties on the market, because a lot of people want to sit on their hands to see how things go. So and then we've got all-time listings around the country and all the stats show that. So a small number of properties on the market, massive increase in demand, and people willing to, FOMO was in the market, low rates. And so a lot of poor assets, unfortunately, have gone up, they've gone up for people. A lot of investors think it was their skill, not luck. But the smart ones have actually come to us and they're saying, I actually knew that was a dog. I knew it was never going to do anything, but it has done. I'm going to take the money off the table. And they're also wishing they did that in 2021, to be honest, because 2022 is different. A lot of those affordability markets are already seeing issues with supply. A lot of people thinking about selling, not just the investors who went to those markets, but the person who said, I've got a house worth 200,000. Now it's worth 350. That's a lot of money to me. I'm going to get out and downsize and buy something else and help me fund my retirement and so a lot of, in these markets as well, you've got the opportunistic seller who never thought that market would be worth so much is getting out, cashing in, I guess. And so, I think that's the appeal. It's just that, wanting, and I think there's a real nice way of, I don't want to be a pensioner. And this is the issues, why the battle with property investors is the bad guy. Well, no, actually they're doing 2 things. One, they're building wealth for their own retirement, less dependent on the pension, which is better for the society. 2, they're providing rental accommodation. 3, they're creating more wealth for themselves that they're going to go and spend in consumerism, and that's going to help the economy, etc. The investor is not the bad person. I'm just saying that, by this number of properties sort of thought process, I think people just, they just think the number matters. The second problem they have is they go to a broker or a bank and they've got a certain amount of equity and they've got a certain amount of borrowing capacity and they just use it. And then 3 years later, like you said, Owen, they've got a bit more borrowing capacity, usually from saving their property, paying their mortgages down, and their house still doing well, which is usually the thing that's happening. They've got a bit more equity again, and then they've got a bit more borrowing capacity. Maybe they had a bit of wage increase and got a bonus or something, and then they go and buy another property. And the beliefs around this sort of number of property strategy, it really used to only work when you could borrow 10 or 12 times your income and rental income, which you could, and when prices of property were much cheaper as well and yields were much higher back in like 2014 or 2015. Because back then you could do that. You could leverage, massively into a big portfolio of properties. Interest rates were higher, so that made more sense than, taking on a home. But in the way that we are now, you can borrow only 6 or 7 times your income versus, 10 or 12 times your income back then. Yields are much lower, et cetera.
So is it primarily people with higher incomes then that pursue this strategy? Would that be fair to say, or how would you characterize that?
I think this is another sort of, you look at all the stats around when negative gearing was potentially going to go off the table, a couple of, the last 2 elections for the Labor Party, for example. You can see that a lot of the middle and even potentially lower income and, medium to high income are big in the property investing because they're going, look, my income's not going to be enough for my retirement. I'm not going to be able to save enough. I'm going to have to do something else. I'm going to go and buy an investment property. And unfortunately, because their house they're in, for example, is only worth a certain amount because that's what the market they're in, they feel it's wrong to go and buy an investment property worth more than their house. And so they end up spending less than their house, and that pushes them to, well, they buy an apartment or villa because they don't want to deal with the maintenance of the house. They make all these mistakes where they just focus on getting a property rather than getting a quality asset. And so I think the reality is if you want to keep on being a portfolio investor, rents aren't ever going to be enough. You can't, and equity is never usually a problem after a certain point because you've built enough equity. For example, you've got 1 or 2 good assets really growing for you. Equity becomes not the problem. Income becomes the problem. And so if you want to keep on building out a portfolio of properties, what you do need to do is keep increasing your income. And so, you want to be buying quality assets, but your focus really should be, I'm buying quality assets, but I'm also doing things to increase my income. I'm investing in my education. I'm looking for the next step up in the career. I'm starting my own business, etc. If you want to keep on buying property, you've got to do both. The property itself won't just keep on allowing you to buy more. You've got to increase your income.
How about if, for example, let's say you buy property 5 years down the track, you then refinance, you've got a lot of equity. Assuming rents would have increased because the property price has increased, do you see people kind of de-leveraging or at least somehow not just keep on kind of binging on the equity? Like, is there a smarter way to use equity in this strategy?
We often say to clients, like a lot of clients, there's this attitude of buy and hold, which I sort of said in the last episode, that's the ideal strategy. But sometimes what we encourage clients, if they have got something that's, got a bit of equity tied up into it for 2 reasons. 1, it's either grown, or 2, they've paid off the mortgage, or 3, they put in a lot of cash. They took out a small mortgage when they bought it. Sometimes it is better when we know that, or, especially if it was in the affordability market, the price of it's really good right now to sell it, or it was in 2021. They cash in, they pay the capital gains tax, pay off their home loan, and try to get debt free on the home. Plus, for 2 reasons. 1, that means that, more protection for when they get to retirement, and, more cash flow on a monthly basis, which allows them to, do other investing like super and other shares and all that sort of stuff. And it just allows them to have more borrowing capacity into, a quality asset. So sell out an asset that's not great, pay off the home, and then do other investing. So absolutely, sometimes people take money off the table to restructure things.
Chris, one thing we kind of touched on in the 3rd episode, but we probably should have touched on this in the 1st episode, was how about when you have the professionals around you? So a lot of people that pursue this type of strategy, they will have a mortgage broker like yourself. They will almost certainly have an accountant. Some of them maybe have a financial advisor, that maybe. They might even have, regulars like a buyer's agent that keeps their, eyes on the street and seeing if properties come available. I feel like it's important just maybe to cover off on some of the incentives of these people, because people that are pursuing the portfolio strategy might be getting advice that's maybe not necessarily the best for them. It's partly because of the professional they're getting advice from.
Well, I'm going to shoot our own industry first. And the good news is with brokers, though, brokers do an amazing job for creating competition in the mortgage market, right? 2 in 3 loans now go to brokers. That was 2 in 5, right? And that broker market share is going up every year. More and more brokers, the number of brokers, etc. And the reason variable rates are really competitive right now, and second tier and third tier banks are getting bigger market share, etc. So brokers are doing a great job for getting better consumer outcomes. I do think now, unfortunately, what they are not don't see themselves as, and don't the role that they maybe are best to play, but to see them more themselves as trusted advisors and say, look, you know what, maybe it isn't a good idea to go into more debt, So the reality is, if you walk into a mortgage broker, same as a bank, and you ask them for borrowing capacity and should you buy an investment property, they're going to say, absolutely, right? Because it's going to be more loans for them in terms of the upfront commissions, but also the trailing commissions. And so that's the big sort of elephant in the room there for mortgage brokers, is that they're always going to incentivize you to take on more debt. And, smart, people who are trying to build portfolios, they try to get a good broker, and the good broker is always getting in more borrowing capacity because they know how to use the system. But they're not stopping you and saying, hang on a sec, are you actually using this money wisely? Is there better things for you to be doing? Should you even be doing this? Most mortgage brokers won't stop you, right? That's the truth. The reality is, if you go into an accountant's office, or fairness to accountants, there's great ones out there, like great brokers. They're going to want to sell your products, whether it's super funds or trusts or companies, etc. Things that they can manage, things that they can charge you ongoing fees for. And so a big thing I see with property investors is they sell them trusts. They try to encourage them to use their super to buy, because that means they're an ongoing sort of a tax return and audit cost that they're going to have to do. Create some sticky at the accounting firm. You're unlikely, if you've got a trust there, your company, your super fund, plus you're doing your personal tax returns, you don't all of a sudden wake up in the morning and say, I'm going to swap accountants, right? And that's unfortunately what we see at accountants, is they're conflicted to sell, structures. Financial advisors, and this is, unfortunately, they're not trained in property. They're not, I was a financial advisor for 13 years. We didn't get many property seminars. It was, this is the best fund. This is the, marketing galore around funds, which, your investors, your listeners sort of know about, but, and platforms and insurance and superannuation and, tax strategies. Property didn't really come into and a lot of advisors don't really know many buyer's agents. Luckily, not many advisors would know more than 5 buyer's agents. We were with probably 50 of them, right? And have gotten that. And a lot of them, unfortunately, get targeted from the property spruikers. They hound financial advisors because they know they've got an education gap. They sell them on all this research. And then if you refer to us, we'll give you this commission, etc. So you've got to be really dangerous, unfortunately, going to financial advisors, because they just haven't got the knowledge there for a lot of them around the property, etc. So hopefully that sort of lifts a little bit around the conflicts out there and the dangers of sort of going to a professional, and then because you're just going to get whatever you don't want to outsource your whole future to someone, and unless you're really certain that they've gone and done all the due diligence for you. They haven't had a call from a developer that, hey, push this for us, etc. So yeah, hopefully that answers your question.
Yeah, I think it's just always important to know the incentives of people, even professionals. Financial advice has got a lot better in the last, say, 5 to 10 years, but still, it's one of those things where you need to know. I would give an example in the final episode when we talk about the end game, but yeah, it's really important that you at least understand the basics and who's selling what and why before you sign up for it.
Yeah, I absolutely agree with you, Owen. I think the financial advice industry is in its best place that it's been since I ever got into the industry in 2007. We sold our business in 2020. The advisor numbers have almost halved, and that means a lot of old deadwood has actually left the industry, and the people who are sticking around, because there's been a lot of changes with fee models, with education standards, with aggregators, costs to actually run a business are much higher. And so the only advisors that are sticking around now are ones who are in it for the long haul. And these are the ones who have got it that, it's not about sort of assets under management fees. It's like about strategic advice fees. And that doesn't matter where you invest your money, because they're not trying to manage your money. They're trying to give you strategic advice. And a lot of them get that property is the biggest asset class out there, and they know they need to get better at property, and they're investing in it, and they are on the right train. I've done courses to educate financial advisors, for example. And so I agree with you. I'm really positive if financial advisors are heading in the right direction.
And I think one of the things that I see a lot of is the one-stop shop. That's maybe something for people to be mindful of too. If you go to where the accountant does your tax return, sets up your trust, and they send you down the street, the hallway to the advisor, who then gives you advice that might be, not necessarily independent of the advice you receive somewhere else. And I think it's just good practice just to have people questioning things, because at the end of the day, that's just important.
Absolutely. I mean, I've worked in these type of businesses before. I mean, a bank's like that, for example. I would always prefer when I'm choosing a business, I'd want to really understand there's a reputation on the line here. I'm working with the business owner. It's usually a smaller business. They're the expert at whatever that is. And there's not a pressure on them to hit certain targets or et cetera. Because unfortunately, in those one-shop shops is, the person stops and says, you know what, you shouldn't do any lending. You shouldn't buy a property. And then the broker's saying, hang on a sec, why are you saying no lending? And then there's a pressure on the business owner saying, hang on a sec, why isn't there referrals to the broker? And then they're, and all of a sudden the tax guys in there saying, hey, they should be doing a trust. I'm like, well, no, you shouldn't, et cetera. So these are all the issues that happen in one-stop shop. They become less about the advice. They become a cookie cutter factory, and it's all about bringing enough income across the business to keep everyone on their seats. And the quality of advice deteriorates pretty rapidly, I think, because it's hard to get great staff in big businesses, let alone to watch over the quality of their advice when it's a big volume going through the business. And so, if it was me, I'd work with smaller businesses that are really focusing on that personalized advice.
Yep, agreed. Okay, so back to the reason I wanted to segue into that, Chris, is because I feel like it's an important point when people think that they're getting the right advice for their property portfolio.
Yeah.
It might actually just be people greasing their own palms and making you feel like you're doing the right sophisticated, complex strategy, when really you could probably keep it simple and have a better outcome. So how about then when it comes to, we've got this portfolio strategy of properties. How can people manage their debt, ensure that they're not over leveraging? We see a lot of interest only loans. We see a lot of, not really like prudent, not necessarily prudent leverage in these portfolios.
Yeah. And I just want to, we'll talk about this debt structuring, and it's a real massive part about it. So it's about buying quality assets, but Bates really understanding how to protect yourself and manage loans, because it's a key element to it all. Things will all fall over if you don't manage that right. The last professional I didn't mention in that last question, which I think is important too, is if you walk into a buyer's agent and you ask them, is it a good time to buy? Yes, they're going to say that because that's what they do. They're there to buy today. If they said it's not a great time to buy, they'd write no business. Mm-hmm. The second thing is, if you think that their budget, you're saying, I've got $600,000 to spend. Is that the right price to spend in your suburb? Yeah, I can find you a quality asset for that. Most buyers agents will think that their location is the best for their budget. So you've got to be careful going to any property person and asking the wrong questions. You need to go like more top down first, think about, well, where is my budget? Where is the best place for me to go? Who's the right buyer's agent to speak to before you go to any buyer's agent and say, should I buy in your pocket? You don't go to any West buyer's agent in Sydney with a budget of 500,000. Some probably wouldn't take you on, but that maybe not be the best location, for example. So buyer's agents are also, heavily conflicted in terms of their own patch. Yes, you get some who refer to other buyers and say, it's not really the type of client for us. Maybe you should go to Brisbane, or maybe you should go to Melbourne. But you just got to be careful there as well.
How do you choose buyer's agents to work with?
So what we do is we get the budget right first, right? So we understand what's the equity, what cash do they need for renovation, how much extra can we keep for a buffer. So we don't just want to use all their equity on the investor property, have no equity left over if there's a drop in valuations or they need to get cash out or for renovation. So we want to try to keep a buffer there as well. Factor in the upgrade, et cetera. So, and then we also want to know how much can they borrow? What's their budget, right? How is that likely to change as well if their income goes up in the next 6 months, or that bonus or their commission element, et cetera. Are they looking to upgrade? No. Okay, cool. So now we know a certain amount they can comfortably go and buy a quality asset. And then we go through the cities, and we very much focus on the East Coast. We say Sydney, Melbourne, Brisbane, and the sister cities off that: Sunshine Coast, Gold Coast, Central Coast, Wollongong, Mornington, and Geelong. We just believe, I could be wrong here, and people in Adelaide and Perth are listening probably like, hey, remember us over here? We just think that a lot of job growth is going to be on that corridor, and a lot of investment, and a lot of people are going to move up and down. That wealth's going to grow in that corridor. We really focus on those three cities. rather than looking at, the Perth and Adelaide, for example. But to get into those markets, you need a certain price point and to get into the quality assets in these markets, so if your budget pushes you to one of those sort of locations, depending on your budget. And then we go and say, okay, well, if it's Geelong, this would be a great buyer's agent, for that budget at 900,000, for example. But if you've got a budget of 500,000, a lot of the smaller budgets, we just don't go anywhere near. We think for them, there's either an income problem or it's an equity problem. And, and if it's an equity problem, then build more equity. That's possible. If it's an income problem, build more income. And if you can't change your income and you can't save much more equity, then maybe property is not the right thing. Maybe just put into shares. I'd rather have $150,000 of shares than a $500,000 cheap property that's unlikely to grow or have a lot of risk attached to any growth. So hopefully that answers that question.
Yeah, it does. How about then just coming back to the managing debt when you're trying to build a portfolio? What are some of the considerations people should have there?
Yeah, so absolutely. You want to basically always be focused on this because what you're trying to do is continue to build buffers, Kimber, to make sure that you maximize your investment debt tax deductions and also be paying off your home loan and always getting the optimal rate. Because as you get a bigger portfolio, you're taking on more debt, right? It could be $1, $2, $3, $4, $5 million of debt, right? And every 10 or 20 basis points start to matter, right? The second thing is that you've also, with investments, the debt on them is tax deductible, right? The interest that you pay. And what you want to do is sort of, and your home is non-deductible interest, right? So whenever you've got a home debt, you don't want to pay off your investment properties because then you're reducing your investment debt, which is reducing your interest that's tax deductible. When if you didn't focus on paying your investments off, you focused on paying your home off, you'd be paying off your home debt, which is non-deductible debt, and you can't claim that interest in your tax return. So with investments, what you do is generally you have to go P&I on your home, which is principal and interest. And then you go interest only on your investment properties. And then you generally can get interest only for 5 years. And the real risk is when people go into a lot of debt for investment properties under interest only terms, and then 5 years down the line, they move to principal and interest because they can only go interest only for the first 5 years. And then they can't refinance and get another 5 years interest only. Nowadays, you have to basically go through a full process. Back in 2014, you could just do a form, ask for another 5 years. Or you could even get 15 years interest only at somewhere like Westpac back then. And so what you generally do to manage yourself is you're trying to always extend your interest only period, assuming you're good with cash. If you just go and spend every cent you've got, then you try to force yourself to pay off things. But if you know how to manage money, you're not frivolous with your money, you go interest only on all your investments and you constantly try to increase your interest only term. So as you're getting up to your 5 years, you're like, okay, I need to refinance and reset that for another 5 years. You're trying to release equity as much as you can, always to get up to 80% on your property values. And when good valuations are around, that's a good opportunity to not get too greedy and cash in. So a lot of people who cashed in on 2021 valuations and got equity are pretty happy right now. We were telling a lot of clients that, prices are very high, valuations are very high. Why don't you release equity? Because when you release equity, it just sits in an offset account. It doesn't cost you anything and it just creates a buffer. So if you don't get a tenant or you lose your job or you want to spend money on the property, you've got that cash there and that can help you fund the mortgage, etc. So these are all the things. You're building buffers, always making sure your rates are good. I mean, the problem with rates is there's a loyalty tax in the system. A lot of industries have this where new customers get great pricing, existing customers get screwed over, right? And they basically are trying to, they're preying on your apathy, right? That you're get a bit too lazy, you're too busy watching maths, and hanging out with your kids and weekend sport. You never get time to look at your mortgage or your electricity, for example. And so the banks have got a huge problem. It's the loyalty tax. The RBA have written about it, and it's bigger than ever, to be honest, because what happens is the discounts we get on new customers are massive compared to what you would have got a discount 5 years ago. And so people have got mortgages, more than 12 months, to be honest, are paying way overs on their interest rate unless they refinance and get, new customer rates rather than existing. So you always have to play that game. So they're the main things. I mean, the fixing and variable, generally speaking, you would go variable, over 30 years. That should be your go-to because, all the numbers show that generally wins. In the last 3 years, it's been a bit of a special occasion. Banks have got so much cheap funding. There was an RBA funding line, etc. And fixed rates were just astronomically low and much lower than the variable rates. We're getting variable rates at 2.5, 2.6, 2.7, fixed rates at 1.9, right? And the variable rates come down a lot. Now it's just under 2%, but fixed rates are no longer, 2%. They're now 3% or 4%. So now all our clients are variable, but sometimes you use fixed to protect yourself for future rate increases. So they're the major structuring things that you're trying to do.
It makes a lot of sense to free up that equity, put it in the offset account. You still get the benefit of the interest, because you still got the equity, so to speak. You have that flexibility, which is really important. It's kind of releasing it.
Offset accounts are a huge thing, Owen. They're absolutely an amazing thing for people who are trying to build, take on debt. Because what it does is it means that you can pay off your debt by putting money in an offset account, because interest is calculated daily. I owe $1 million. We've got 100 grand in my offset account. I'm paying interest on 900,000. If I take $50,000 out of my offset account, I'm paying interest on 950, right? So you're paying interest on a smaller loan, but you've still got complete liquidity. And so when I say going P&I on your home loan, yep, but it doesn't mean you pay it off faster. And you should extend your loan term every couple of years to 30 years, because it means that you're paying it off slower. And what it means, you've got more cash in your offset. And what you're trying to do is build your offset as much as you can. Keep your investments under interest only. So I missed the offset point. The thing about cash out and equities is sometimes it's really hard. And it was hard a few years ago, especially around the Royal Commission. And sometimes getting cash out up to 80% is really easy. We've done some massive cash outs in the last few months, well over $1 million, $1 million, 1.6, over $2 million. We're doing a 2.7 at the moment. Big cash outs are possible when times the banks are willing to do it. And sometimes no, you can't get cash out more than 100 grand. And so secondly, your valuation can always fall, right? So you can get cash out today and your place is worth 2 million. Well, now the place's valuation is 1.7. You can't get any cash out. Or maybe you've, that client I was talking on a previous episode, high income, maybe they can get cash out today, but when they start that business in 2 years' time, they can't get any cash out. That's a perfect time to get cash out income drops. So obviously assuming that you don't go and waste that money on lifestyle spending.
For sure. Yeah, that's the big asterisk.
And that's it. And we're talking to an educated, sophisticated client, right? Who is not at that sort of starting out stage. Has got 7 credit cards and a car loan and Afterpay. And this is the type of clients this is suited towards. It's not to that sort of first investor that's, living off their home equity to pay for school fees and, go on holidays. That's just a different type of mentality.
Yeah. When we were talking just before off air, we're saying what do we want listeners to get from this series? Because a lot of the stuff that we talk about is share investing, businesses, companies, that sort of stuff. And basically what I wanted to do with this is just basically activate people, to get them, and we both want that, to get them thinking about property, how they can use it tax effectively, or if they have equity and how they can use that. Because I've spoken to a lot of people on the show, and I know you listened to this episode that we did a while back with Andrew Page, and he talked about one of his bigger regrets, even though he's a fantastic share investor, absolutely fantastic. He regrets selling his home, even though he did so well from shares, because he should have just thought differently, more proactively about maybe I could have used a line of credit and bought the shares instead, rather than just selling out of my house and moving rentals with a family. There is...
the other point to that, Owen, is that it's very hard to argue with leveraged property returns versus share market, right? Yeah. We'll talk about, for example, we had lots of clients buy in Brisbane and, pre this last boom, and they bought, old Queenslanders near the city, on good streets, things that, people leaving Sydney and Melbourne would love to live in, they're quintessential sort of nice looking homes, right? Maybe they need a renovation or something like that, but they're solid land. They're buying them from 700 up to say 1.1 million. Most of those properties are up 70, 80%. The investment properties, so they haven't put any cash involved to buy them. They've just been a negative, and rents up there were almost covering the mortgages because yields up there were quite high, around 4 or 5%. They haven't had a big cash flow cost. So for that small, potentially negative equity, their $1 million properties now worth, say, at 1.8, right? Even after capital gains tax, that's like 600 grand. I know this isn't what you typically see. And even, someone who's put in 150,000 to buy a home, and then that property's gone up 50%. Well, that means their cash has gone from 150 to say 450, right? To 600, which is a 400%, 300% return after tax. It's hard to compete with that in property. And that's only, so if you do it right around property, around both homes and investments, it's really hard to compare those returns to day-to-day share investing that's unleveraged. Even if you're getting outperformance on the markets, and even if you're in small cap, etc., you'd have to be getting 20 or 30% compounding returns to compete with these sort of returns in property. Now, I'm not saying this is the returns you're going to get going forward.
No.
The growth return going forward is going to be much, much lower is for the market, because we haven't gone from one income to two incomes buying a property. The husband, this is very stereotypical, used to work, and now the wife works. The one is maybe work part-time. Now both are working full-time, and they're both on high incomes, and they're both, that's why they can. So you're not getting those uplifts. You're not getting the interest rate tailwind, potentially lots of other things as well. So
you make a fair point.
Yeah. So growth on property is going to be much lower. And, this property market, I've seen the nonsense pop up as well after this boom. Oh, yeah, property does double every 10 years and all that sort of stuff. I'm like, no, that was under a massive tailwind, and it really things that, rates dropping to 2%, that's what caused this. So, but if you're even getting 4% compounding returns on property, which would be a great result, that still versus share investing, because it's leveraged, is really hard to beat.
Yeah, you make a great point. Even just the tax advantage nature of certain things as well helps. And I think people become very is it parochial? Is that how you say it? Or parochial, where they just kind of think, "No, this is me. I'm a share investor. I don't worry about the property. I'm a property investor. I don't worry about shit." It doesn't matter. At the end of the day, we're talking about wealth creation here. So that's basically what we're trying to get to the bottom of.
If you are one of those, you've got to realize that you sort of got a blind spot, right? If you are an avid share investor and you're doing really well out of shares, you've got to also understand that, potentially you could have made some money in property, maybe upgraded your house. We've seen this, a lot of people, is that they, potentially could have just upgraded their house and made millions of dollars there as well, because they had the income, they had the cash. And so you can do both, that's the thing. And I think the other thing is it's the stage of life thing. You have to admit that when someone is younger and they've only got a smaller amount of cash and they can borrow a good income, they can get into a great property. That's going to be better than them leaving that money in a share portfolio, compounding at 7-8%, right? And so it's a life of stage thing. I think you use them as tools at different market cycles. You go in harder on shares at some points, as you get close to retirement. Residential probably doesn't make sense. We generally don't work with clients in their sort of 50s, 60s. We sometimes will help out, the parents of clients, et cetera, and just make sure they're not making any silly mistakes. But we don't look for that market at all. And the reason is it's really hard to advise them on making any sound property decisions, because residential property doesn't really make sense getting close to retirement. I'd much prefer to be, building a share portfolio and using my equity for that, and having maximum super and commercial property and all these other things versus lumpy residential property. So it's a stage of life thing. Use them both, but don't sort of sit too much in one camp, because I think you're missing the trick.
That's what we're going to talk about in the next episode. The last episode of our property investor mini series, we're going to talk about how do you wind down if that's your way. Like, how do you transition if you've got property, if you're comfortable, what do you do next? So Chris Bates from Wealthful, mate, wealth of knowledge. We're going to be back for the final episode right after this one. If you haven't already, listened to episodes 1, 2, and 3, where we talked about basically an intro into property investing. We talked about upgraders, and we talked about first-time investors. Chris, I'll see you in the next episode. Thanks for joining me.
See you soon, Owen.